Hello, everybody. Welcome to week 6. We've pretty much almost worked through everything already, so hopefully you guys aren't too fatigued and you're learning a lot. And I'm excited about finishing the semester strong, being able to learn a little bit more about some complex instruments through derivatives and options. So the first thing I want to do, I'm not going to be going and referencing the PowerPoint. I want you guys to look at it. And this really ties in with the discussion that I want to have with you guys. I want you guys to kind of figure out the 4 main ways to make money in options. And so my best description of an option is that instead of choosing to own a stock, if you choose to buy an option, you are choosing to, in a way, pay a fee or pay interest for the right to future appreciation, to the future growth, past a certain level. And so hopefully it'll work as you guys kind of see my examples. But you can make money by buying calls, buying puts, or by writing or selling calls and puts. And so the sides where you buy the puts or calls, what you're actually doing is you're taking kind of a little bit of a risk. It feels a little more like gambling than normal stock investing, especially since you don't have ownership in anything. But you're taking a risk that you're going to see big gains, or you're going to see the stock fall by a large margin to the point where all of a sudden your option kicks in and you have the right to increases from that point on if you're buying a call, or decreases from that point on if you're buying a put. And so I want to understand the 4 sides of that trade: buying and selling calls, buying and selling puts, and how to make money, which direction you'd expect the market to go. And so I'm going to show you some examples. You can read through the PowerPoint. It's probably, it's necessary that you look at, but I want to look at just an actual opportunity to invest in that if you have Robinhood. This is the desktop version of that. Most people who use Robinhood probably don't care to look at it, but ultimately what you're going to do, and we're going to use the examples of Wells Fargo, okay? If we wanted to buy an option in Wells Fargo, we would look at the company. It's trading at $29.74. All right. We're going to try to figure out a way to buy some options there. And so what we would do is we would first click here. And what I really want to show you are the different available prices and options. All right, so the stock trades at $29.73. All right, so if we wanted to buy an option, all right, we're going to have to pick a strike price, and we're going to have to pick a date. And what those represent to us are the price at which appreciation from there on we have the right to. Okay, so simplest example, at $29.73, let's say we buy the $30 strike price. Okay, we're going to pay a premium for that right now. Okay. Oh well. Okay, so all of these options expired December 24th, which is 3 days from the time when I'm recording this, and so it's not really a good idea. It's a risky idea, I should say, to buy call options or puts or any options that have a shorter time frame. Right, the longer time frame will cost you more, but you're going to have a more of a right to future growth, because growth usually takes time in a stock. So let's say we wanted to go out 1 month, a little bit more, to January 29th. All right, so here we see, all right, that this option would cost us $1.52 to buy. Okay, now whenever we buy options, we usually buy them in denominations of 100. And really what we're doing here is we're leveraging our money okay, to get a greater percentage return on an investment. So normally, if you wanted to say purchase Wells Fargo, right, 29.73, let's say you wanted to buy only $100 of that. Well, that's not even going to get you 3 shares, okay? Now, if you wanted to buy an option to buy a call, you could spend just 95 cents per share, all right, for a $31.50 January 29th option. At which point, okay, we would start making money at $32.45. Every penny up from that point forward, we would have a right to, okay? And the stock owner wouldn't necessarily have the right to. And so the person who writes the calls, okay, they're just looking for a steady percentage return on their investment. And they're saying, you know what, even if it goes big, that's okay, because I'd rather have the guaranteed 94 cents that someone's going to pay me if they buy that call. Okay, and so the question is then, all right, if we look at this example, 31.50, all right, how do we get to a break even of 32.44? And it's really simple, all right? You take the price that you would have to pay plus the strike price, which is the price at which you can actually exercise the option and sell it for money, okay? And now, you know, you could also buy your call if you wanted to and sell it before you hit the strike for whatever it's valued at as well. Like kind of like on the second, it's a secondary market for those as well. But nonetheless, most options expire without anybody making any money. Well, the writer would make the money, and the person who buys the call would lose all of it. Okay, so if this stock never gets $31.50, I will never be able to exercise the option, and it will expire useless. So I will have lost all the money I invested in it. Here would be if I bought 100, which is basically one call, it would cost us 94. And so here you can see that example, okay? So that's how you make money buying calls. And you know, puts are gonna be a little bit more difficult to figure out, but it's the exact opposite side of the coin, right? If you're buying a put, you're expecting the market to go down, okay? And you're basically doing the same idea as buying short, where you're selling something first and buying it back later at a different time. So here you can see those examples. All right, on the call side, people are really expecting, especially banks, to probably go up, and you expect the market to go up. And so if it goes down, it's a little bit more less likely, I should say, probably. And so you see these puts at $1.49, $1.26, 90 cents, 74 cents, and so forth on. All right, here you see one. If it's at $27 between now and January 29th, you can exercise that put. You won't start making money on it since it costs you 61 cents per share to own the put until you get down to $26.39. So there's the second side of it. So we've got buying calls, buying puts, but what about selling calls or selling puts? Well, again, you're working, you know, on the other side of things. You always have to have two sides of a trade, right? So here we see someone who wants to sell a call. Okay, again, the stock price is $29.74. We're still working with January 29th. All right, if you want to sell a call, okay, you have the potential to make say 95 cents per share. Okay. However, if the stock goes above that, all right, you either have to own it or you're going to cover the fact that you're selling it, or you're going to have to pay on the appreciation above that. Okay, so that's kind of what that would look like. And so you see immediately, I'm not paying 95 cents for this call option. I'm actually getting a credit for 95 cents. Okay, and then if you see it go up past 31.50, you know what I mean? The break-even point for this one would be if it goes to 32.45, I would break even. If it goes above that, I'm losing money, and if it goes below that, I'm risking money. So one interesting strategy, like when you sell puts, since you're selling on an expectation of depreciation, you could always go ahead and put in a order to sell a put. People also say write the put. So let's say you did that for $28, right? You would get 89 cents. And so if the stock goes below $27.11, you have to pay the difference, or you have to go in and go ahead and purchase those puts that you would put in. But a lot of people say, you know, if I pick a good company that I like and it happens to get beaten down a little bit, I don't mind buying Wells Fargo, you know, below 27.11, which, you know, can be definitely a good strategy. Nonetheless, you know for sure that you're going to be getting that 89-cent return on it. And so selling puts and calls is almost a, you know, kind of it's still definitely risky, and there's still a lot more volatility and options. Again, like my PowerPoint says, what you're looking to try to do is leverage your situation. But in the end, selling puts and calls gives people that steady stream of income, you know, over the course of investing. And so like usually options aren't something that kind of the everyday trader uses. These are tools that the big institutional guys use just to make sure that they're covered. And so they never want too much exposure to the market. And so let's say they go long 10,000 shares of Wells Fargo. They'll go ahead and put in an order to also buy some puts. Just in case the stock does happen to hit rock bottom, then they actually will be able to balance out the fact that they own 10,000 shares long, but that's okay because you know, they bought some puts to kind of insure themselves against it. I think those are probably better options than short selling. Short selling comes with it extreme risk on the long side. But I wanted to show you guys this, and Robinhood does things a little bit different. They have this break-even number, whereas the other, if you go to TD Ameritrade or the other discount brokers, do show it a little bit differently. But I mean, it makes does kind of make a little bit of sense the way that Robinhood does it as well, even though it's not, I would say, not traditional. Nonetheless, that's how options kind of work. You know, options are, you know, something that we should at least learn about in this class. I don't know if it's the gist of what we need to do. If we really need to look too much into, you know, how to value those things, as long as we understand how you could make money in each of those 4 different options: buying puts, selling puts, buying options, or buying calls and selling calls. Then hopefully you'll understand that. And you know, I probably dove right in real quick and didn't talk enough about, you know, what exactly calls and options are. And so, you know, hopefully you're able to look at that PowerPoint and kind of parse through that as you guys discuss this information on the discussion board. That is all. Next week or our next, you know, session will kind of be going over a review. And so, you know, I'm good with questions on that time period. Once we get a little bit closer, hopefully maybe we could, if we needed to, even meet together for a Zoom session. But I'll try to correspond that through the announcements if need be. I'm still on the beginning of Christmas here, so that'll be, of course, you know, come after the new year and the start of 2021. But thank you guys. I appreciate all you're doing and your hard work, and hopefully you're still learning well and able to do some research. You know, one other thing I was going to mention, that Jim Cramer little chapter that I put out helps really, if you read through it and you can read through it kind of slowly and meticulously, I think you'll get what options do and how they operate. All right, that's all. Have a good one, guys. Thanks. Bye.